Good afternoon, everybody. Welcome to the first 12B webinar for Fund 2 for this year. It gives me great pleasure to have two of our guests today, which is Tivan Laubscher from the 12B Green Energy Fund and Victor Bukaritsa from GRB Investment Brokers. I will be facilitating today's panel. My name is Jeff Miller. I'm the CEO of Grovest Investment Holdings, and look forward to a very, very interesting hour. So let's start off. Tivan, will you please introduce yourself? Tell us a little bit about you, who you represent, etc., etc.
Yeah, thank you so much, Jeff, and a warm welcome to all our listeners. So as you mentioned, I'm the fund manager for the 12B Green Energy Fund. We closed our first fund last year and we have just launched Fund 2, and likewise looking forward to a very informative discussion. I know Victor has some very interesting insights.
Thanks, Tivan. And Vic, please introduce yourself.
Wonderful. Thank you. Good afternoon, everyone. My name is Victor. I'm an executive partner and wealth manager at GIB Private Clients, and we look after a bunch of people, including high net worth individuals and families, to assist with their structuring and portfolio construction.
Right, thanks, guys. So before we get into the nuts and bolts of today's discussion, just a little bit of housekeeping. There is points that we can CPD points for everybody who stays online for the full hour. There is a 1 CPD point that you can use in your scorecard. There will be questions and answers that you can ask at any time. You please use the Q&A chat and we'll attempt to answer those questions, and I'll direct them to the respective person who I think can answer best. And just feel free to ask any questions, and if there's no stupid questions, if you want to ask anything, please feel free to ask. So let's kick off. Tivan, you've recently closed the first 12B Green Energy Fund 1. Tell us a little bit about it, what it consisted of, the construction, the expectations for the investors, and what it means to them.
Yeah, Jeff, so rightly so, we closed Fund 1 at the end of last year. And just to give a high-level overview, in a nutshell, what 12BA is, Section 12BA of the Income Tax Act, says that, it's an accelerated wear and tear allowance. And what that means is our investors can reduce their taxable income by 125% of their invested amount. The very important caveat to that, and maybe we can chat a bit about that, Jeff, is that the money has to be deployed into renewable energy generating assets. So we're very proud that we deployed all the money, entitling all our investors to their full 125% deduction. And we've developed a really well-diversified portfolio. And I would also love to chat a bit about our projects in Fund 1.
Okay, great. Thanks, Tivan. So, Vic, as I understand it, you put some of your clients into Fund 1. Tell us what the reasons why, your expectation and your experience.
Sure, wonderful. Yes, yeah, we did put some clients in. I think it's important to understand that 12B is a great thing when used correctly. It's not necessarily for everyone. I thought I'd share a couple examples of certain areas where we found it to be highly valuable. So right off the bat, anyone who's in a high tax bracket and paying a lot of tax is going to be on a good wicket and benefit from the 12B tax incentive, subject to the fact that these portfolios or that these projects return positively, which they are positioned to do so. So a couple areas where we found some great value. A few examples are clients who had large CGT bills in embedded CGT, potentially they had a business or share portfolio or property that they had been hanging on to for the longest time, wanted to move on, get rid of, change the setup of it, but we're so reluctant to do so without CGT triggering there. 12B came along and offers an opportunity for them to realize that CGT and then immediately offset it by utilizing 12B. So we're quite pleased with a lot of clients being able to do that. Some other areas that we found quite interesting is what we could almost call a bit of a two bites of the apple opportunity for some clients, not for everyone, but some clients who made lump sum contributions into their retirement funds every year to get 100% tax deduction from a retirement fund level. We sort of swapped that in for some clients to get 125% tax deduction through 12B, and then the distributions from 12B are going to be used to eventually make their way into their retirement fund, getting a second bite of the apple then, and at the end of the project, when they get their lump sum back, they'll make those contributions into the retirement fund later down the road. So they're effectively getting a 225% tax deduction on the same money, because they're using two tax incentives for that there. And a third example I will share just very briefly is almost what we could call a tax arbitrage opportunity for a handful of clients, where either it was a trust that wanted to offset some tax, and the beneficiaries of the trust who would receive the ultimate distributions from the 12B fund were in different tax brackets. So the trust in the 45% tax bracket, but the beneficiaries were maybe in the 18 or the 31% tax bracket. And that getting a tax deduction at the top level that's quite attractive, and then paying a lower level of tax on the way out, added or were expected to enhance the return, and just added to the opportunity of 12B. So those are a few examples outside of the norm, but the vanilla thing is really where we found clients were in high tax brackets, had a portion in their investment portfolio to invest into alternative investments, and it was suitable to their risk profile and suitable to their strategy and their objective of their investments. We found some great opportunities there.
Very interesting. So, I mean, you've actually used it quite, let's say, innovatively to your clients' needs and requirements. So it's quite technical. So let's do the following. Can we put out a poll 1, which will just give us some idea of our audience if they have invested in the 12B product previously, and then also after that, if there's a poll B, just to say what type of investor you are. So can I ask the technical team, if you don't mind putting up poll 1, we'll put that out there for a few seconds, and if you can just say, have you invested in a 12B green energy fund? Or it doesn't necessarily have to be the 12B green energy fund, it could be in another fund, and or you haven't. So then we can just get some sort of feel as to who is in the audience. All right, guys, I think that gives us sufficient time. Can we give the results of poll 1? Okay, so most people haven't invested in a 12B fund before, and some have invested in the 12B energy fund, and some have invested in a competitive 12B fund. So that's interesting. So 1/3 have invested into 12B funds, and 2/3 haven't. So that's very, very interesting. So hopefully we can convert the guys who've never invested into a fund to actually include the 12B opportunity into their portfolio. Can we put up poll 2, please? It'll just give us some sort of indication of, are we talking to individuals, companies, trusts, wealth managers, or a prospective EPC partner, and that would be somebody who would want funding for their solar projects. That just gives us sort of idea. There is obviously different tax benefits for companies as opposed to individuals and trusts. Individuals and trusts, assuming that you're paying tax at the marginal rate, will be charged 45% tax, as where companies only 27% tax, but you still have capital gains tax, and you also have dividends withholding tax when you declare dividends. So quite interesting. So can we have the results, please, of poll 2? Okay, so the vast majority of this is individuals who want to invest, say, tax in a personal capacity. Let's see, we have 2 potential EPC partners who are looking for funding for their solar portfolios, and I would ask that you would contact Tivan after this webinar, make contact with him so he can then investigate and take that offline with you guys. Also interesting, and welcome to the wealth managers. There's 7 wealth managers on the platform, and hopefully they too can be enlightened so they can sell the product on to their clients. Okay, so guys, let's go into some other questions. And you know, so there's firstly, Vic, this is to you. I mean, 12J was around for a number of years. It had a sunset clause in June 21. There was 12 billion rand that was raised into that asset class, and then obviously, not to say that 12B wasn't around, but it wasn't focused on, and now 12BA was introduced in March 23 till Feb 25. Tell us what's it, in your opinion, is there any difference between the 12J and the 12B or 12BA initiative?
Sure. So beyond the technical differences, specifically around how long one must be invested, the requirements for what qualifies as an investment, there are some nuances there. Beyond that, I think some of the, and you can speak more to that on a technical perspective there, Jeff. I think beyond that, both of them are similar in that they were investments into typically private assets, and you would receive a tax deduction for doing so. And the government would provide this incentive because it wanted to incentivize certain behaviors, in this case, the generation of renewable energy in the 12B case. One of the big distinguishing factors between 12B and 12J, in my mind, are that 12J, to be fair, the majority of 12J funds offered fairly mediocre returns if you stripped out the tax benefit. So if you ignored all the tax benefit, the 12J returns were maybe 8-9% return. You then add the tax enhancement, and it would take those returns to a nice attractive level, 13-14% annualized return. 12B is different in my mind in that I believe the projects and the return profile, whilst extracting, while not accounting for the tax benefit, is already an attractive and lucrative potential return. At a project level, looking at about a 13 or 14% return. Adding the tax sweetener, the 125% tax deduction, and then also noting the tax upon exit, it enhances that return to closer to sort of 17 or 18% returns. So I think that's one of the major distinguishing factors that makes, in my mind, 12B a little bit more appealing, is that at a pure investment level, it's already attractive. Of course, it comes with risks, which we'll address as we go throughout the webinar, but the risk return is already quite attractive. Then you get that really good-looking tax enhancement, which takes those returns from really good to excellent. And I think that's one of the major distinguishing factors around things. A couple big things that are worth noting around 12B, and Tivan did touch on it, is the deployment of funds. So 12J funds had 4 years to deploy capital into projects, which basically meant you had a bit of a drag on returns. For 4 years, you were just earning a cash return, or money was sitting in the bank for a few funds, not all of them. Whereas 12B, the funds have to be deployed and generating electricity within the tax year that the incentive is given, which really lights a candle under the bums of the project providers, such as yourselves, which means that one is starting to generate returns on the projects more immediately, which is quite a positive thing from an investor perspective. I think, yeah, those are some of the major distinguishing factors in my mind.
Yeah, so I think also having Grovest, having been the founders and the first operational 12J in the market, and with 3.5 billion of 12J assets under management, and then now working through the 12B scenario, I can tell you that 12B is a far better alternative. Not to say that I was very happy when they stopped 12J, because I think it was a bad decision by government, short-sighted. But that said, there were a lot of legislative and quite rigorous laws or rules that you had to have for 12J as opposed to 12B. And probably the biggest one is the liquidity. is that you had to hold the 12J for 5 years, whereby in the 12BA, you just have to hold it for a minimum of 2 years, otherwise of a full recoupment of your 125%. But they, subject to the liquidity of the fund, that you can get liquidity at any point in time, obviously subject to the performance or the cash flows of the fund. And also, there was also a lot of other governance inside it. No one investment could be more than 20%, couldn't be more than 50 million. There were a lot of tough issues. So I think 12B really takes that all out of play. And here, instead of getting 100%, you're now getting 125%. Okay, so we're focusing on the 12B and the 12BA. Do you want to just, Tivin, give us the difference? What is the difference between 12B and 12BA?
Yeah, right, Jeff. So 12BA was announced at the last budget speech, and essentially it works on a similar mechanism to what 12B was. It's to stimulate the investment into renewable energy generating assets. But 12BA has come around now, and it's essentially an enhanced 12B allowance. So instead of the traditional 100% accelerated wear and tear allowance, you're now actually able to capitalize on an additional 25%. But again, and I don't want to flog a dead horse, but it's a very important point. The caveat that the assets have to be new and unused, and they have to be deployed in the respective tax period. And that's something that we at 12B fund managers have been very cognizant of. The 125% tax allowance is very important to our investors, and we place a lot of focus on getting that deployment over the line. And again, very happy that we managed to do that. And I think if I can chat just about the portfolio diversification a bit. So we have it in our investment charter that no one project will make up more than 20% of the weighting of the overall portfolio. So we managed to diversify Fund 1 across 10 different projects, different sectors, different regions, and also with different underlying contracts and terms. And I think, again, back to Vic's points about how the investment really stands on its own, hitting a 15% threshold at the project level, which is then bolstered up to 18% at the investor level. So it really is an attractive investment all round. And the other important point, and I think, another really attractive factor, is that it's a collateralized investment. So really, reducing the risks to a certain extent. And I think that's another beauty of 12B compared to 12J.
So I would agree with you, is that here you actually have an asset underpin that, if I'm not mistaken, is around about 70% of the let's say the solar kit cost. So if worst case scenario, you did not get paid back from an off-taker, you could uplift that equipment and you could deploy it, and possibly there could only be risk of about 30%. Is that correct?
Correct. Yeah. So we've done loss given default analysis, and you're 100% right. We are able to uplift the major hardware components, whether that be batteries, inverters, solar panels, and we're able to redeploy them. And I think the two major risks we've identified with this investment is deployment risk, and I've mentioned how we address that. We have an extensive deal pipeline. We've got partnerships with various EPCs in place. We've got various business development personnel and intermediaries who are bringing us really amazing projects that are meeting all our thresholds. And then the other one is obviously off-taker risk. And the way we mitigate that, it's lovely that it's collateralized. As you mentioned, 70% can be uplifted and redeployed. But we also do extensive credit checks, credit analysis on the off-takers, ensuring they are creditworthy counterparties. I'd go out on a limb and say I think we have one of the most experienced investment committees in the 12B universe. And they really put myself and the analysts through the ringer when it comes to passing projects. But I think it's just added surety around off-taker and credit risk.
Nick, having heard from Tivan, who giving you all the pros and identifying the risks and that as a wealth manager, I mean, how do you feel? I mean, or you're putting, let's say, this type of product into your client's portfolio. Do you consider this private equity? Do you consider this venture capital? How do you view the 12BA investment?
Sure. So how do we view it, and what are some of the cons? Well, where do I begin? Digest. So I think this is structured as a private equity type investment through the partnership. But I think the way we think about it is more as a private infrastructure type investment. So not to get too technical, but it's a lot more bond-like in its nature, in that these are contractual cash flows that are set up with power purchase agreements that are in place, where one has foresight of what the cash flows will look like, what the profits should look like in the future, which means the stated expected returns are very attractive, but don't have a ton of upside above what was noted there. So there's not going to be something strange. It's not like you invest in a mine and they happen to find some gold on the piece of land they own and suddenly the share price triples. There's that expected upside is not going to go through the roof, but there's also that downside protection. It's not going to be something you wake up tomorrow and find out that this company went belly up or went bust, because there are these contracts, this contractual cash flow. So we think about it more as a private infrastructure type investment through a vehicle that is typically a private equity type vehicle. And it's important to be aware of that. So when we communicate with clients, this is a private investment. So it falls within the alternative investments universe, which means it can't be viewed at exactly the same way as other listed investments. For example, the return profile for the risk that one takes on is a little bit different, in that one can take on moderate or mediocre amounts of risk and still get fairly attractive returns in the 12B space. Where that return is coming from is the illiquidity that investors need to be comfortable with. So an investor needs to be comfortable with the fact that they can't invest today and exit in a year's time, or in 6 months' time, or maybe even in 2 or 3 years' time. Yes, there are the cash flows that will pay to investors, which we'll speak about as we go along, which is great. It's creating this regular stream of income for investors, but there's much less autonomy for the investor to decide when they want to increase or decrease or enter and exit this investment. It is more structured because of the partnership structure. So for more sophisticated investors, it's normal, it's part of the course, they understand these things, but this is by no means the investment someone should make as their first ever investment. The listed space is great for that, but this alternative investment space, or this private space, is for the slightly more sophisticated investor, and probably one who has the capacity to absorb that illiquidity, i.e. someone who has not a huge portfolio. You don't have to necessarily have a gigantic portfolio, but because of the minimums with this investment, you don't want it to be the majority of one's portfolio. So they should have a sizable chunk of change elsewhere that is not this 12B. So I guess how I could summarize things is, if someone's paying a lot of tax, they probably shouldn't have zero invested in a 12B investment, but they probably also shouldn't have 100% of their portfolio in there. And we find for our clients, the sweet spot is sort of between 5 and 10% of their overall total portfolio is how much we would recommend, depending on client needs, of course.
But Tivan, just, as a fund manager, what can an investor expect in terms of returns, in terms of IRR, in terms of cash yield? How often, is there a dividend paid? And if so, how often? What can the investor expect by investing in the fund? And what are the minimums as well?
Right. So I'll start with, so the minimum investment is 100,000 Rand. And investors can expect to see an 18% IRR on your risk capital. And we're looking at about a 14.2% average annual yield. And that's paid out biannually. The tax benefit, the 12BA tax benefit, is extremely lucrative and extremely attractive, but then you're also getting a high cash yielding investment, as well as it actually being a great impact investment. And I think that's one of the reasons I'm so passionate about this particular product, is it's so much more than just a traditional returns-based investment. You know, obviously we're always looking for great returns, and 12B definitely does that, but there's so much more. You're getting that brilliant tax allowance to reduce your taxable income, and then you also are, you know, aiding South Africa's transition to a greener and brighter future.
Okay, well, we'll drink to that. Okay, so to invest, tell us about Fund 2. Tell us, you're in the process of launching Fund 2. Tell us about what that will include, quantums, how you intend raising the capital, how you intend deploying the money, etc.
Yeah, so we've probably been live now with Fund 2 for around a month, and the uptake has really been exceptional. I think a lot of our Fund 1 investors learned the benefits and have decided to reinvest into Fund 2. And we're also seeing a lot of people who missed out on the deadline last year now getting in. So we're looking at raising 100 million rand, and we're well on track to that milestone. The fund, it is important to note, the fund operates on a first come, first served basis, and will close at the early of 100 million or the 30th of June. And yeah, we have extensive deal pipeline to match that 100 million rand. So we don't foresee any issue in deploying the capital. And we also have, we have really attractive projects coming up. I sit with the investment committee every second Wednesday, passing projects, and we really, really have an exciting pipeline going ahead. Some of the things I want to focus on, again, diversification in the portfolio, ensuring collections risk and credit risk is spread. No one project will be more than 20% again, looking at diversifying some of the underlying cash flows, the underlying terms, and obviously across sector and geography again.
Okay, so that's very, very interesting. I mean, because I think last year there was, at the end of the day, everyone that funds took in money, and my understanding is that you had to deploy the money into energy generating projects before the 29th of February 24 in order to get that. So I understand that your Fund 1 did that. But I do also understand that there were other funds in the market that didn't achieve that milestone, so people didn't, or investors didn't get the full benefit. What, in your opinion, I mean, if you raised the 100 million before 30th June, I mean, are you confident that you'll be able to deploy this?
Yeah, I mean, my pipeline is extensive. So from, just for interest sake, I had a great meeting today, and from one intermediary, we're looking at around 80 million rand. And we've cast our net really wide. So we have various EPCs on our books now, and various reputable EPCs, because that's the other thing you have to look at. It's one thing doing credit analysis on the off-taker, but you also have to make sure that the construction company or counterparty you're dealing with is also reputable. I think solar industry has been a bit of a gold rush, and you're ending up with a lot of fly-by-nights or bucky builders. So we also take or have a very stringent due diligence process on the installers, because remember, we're taking a long-term view here. We're entering into 20-year power purchase agreements with these off-takers. So we have to ensure that the installation works of a very high standard.
Okay, so just, I think it might be appropriate to take some questions that have been floated, and some of them, are common. There'll be more than one question which maybe covers the same topic. So, to you, Vic, I mean, the question is it a once-off deductible allowance, or can one, assuming the tax, you invested 1 million rand, your taxable income was 600,000, can you carry the 400,000 that you didn't use in this year to the following year?
Sure, great. So I think firstly, just to answer that question, I'll keep you guessing till the end. Perhaps it's wise for me to just take a minute to describe the investor experience, how it would live through this fund. So an investor would make an investment, and they would then, depending on how they pay tax every year, if you've already paid your tax, so typically a PAYE, pay as you earn taxpayer, you've already paid your tax for the year, you then make a contribution, you will receive money back from SARS. That is how you will receive your full tax deduction. If you're a provisional taxpayer or someone who hasn't paid tax yet, you will just pay less to SARS. You will owe SARS less than you would have. That is how you receive the tax benefit. So one way you'll receive cash that you overpaid, and the other way is you just won't pay as much tax as you were going to have to pay SARS. But the numbers are the exact same. The investor will
say what you didn't say, if you your taxable income was 600,000, you invested $1 million, you could then get $1 million times 125%, so you'd get 1,250,000. So effectively, you can then take the 700,000, you'd pay your 600,000. You get your tax shield this year for your tax allowance, and then you roll forward your 750 to the following year. So,
yes, so you can have that. You can view it as an assessed loss almost. You can get the benefit to roll over into future tax years. So if you effectively oversubscribe for your own personal tax bill or taxable income. So in your example, if you're earning 600,000 Rand taxable income, but you invest $1 million, you get 1.25 million deducted. Well, the first 600,000, you'll carry forward the 650 into the following year. But to just come back to the investor experience. So in a case where an investor invests less than their taxable income, they'll just get it in that first year. In a case where they invest more, they'll roll over and they'll get the tax benefit, and it can keep rolling forward as long as the amount exists and as long as they've offset the taxable income. So someone who's earning, for example, 500,000 Rand a year, who invests 2 million Rand, would get more than 4 years worth of tax deductions that they could roll forward. And then, so coming back to the investor experience, so in that first year, investors would get a nice big fat tax deduction, either as a cash payback or as a reduction of what they would have had to pay SARS. They will then, every subsequent 6 months or so twice a year, they'll receive a distribution. It's a distribution, not a dividend, so they'll receive income from the projects that'll pass along to them as investors. And that starts at a fairly attractive yield, close to the 10% mark, and that's escalations are built into that, so it's expected to climb over the investment period. So investors will start receiving these semi-annual distributions, and then in year 10, it's expected that the fund, and Tivan can speak more to it, it's expected that the fund will be able to sell off the remaining years of the power purchase agreement, and in year 10, clients will get their final big fat lump sum back in the form of a big distribution and payback there. So just being aware of that investment time horizon, I think, is a very important thing, that investors need to be aware of the fact that this is a potentially 10-year investment, whereby they get a nice tax deduction up front, they receive cash flows throughout the 10 years, but they really only have access to that lump sum that they invested again in year 10. Tivan, I'm not sure if you want to add a little bit around the distributions there, the lump sum at the end, or anything to that effect.
Yeah, definitely. I can chat about our exit mechanism. It's an interesting question because, as I mentioned earlier, we're signing 20-year power purchase agreements. And as you correctly mentioned, the fund term is 10 years. So what we model to do and what we envisage doing is selling the paper. So selling the cash flows from year 11 to the end of year 20 to a third party, and we've modeled it at a discount of 13.5%. Now, this might sound fairly strange or unusual, but it's actually common practice in the finance world. And I think another benefit with Grovest and our particular 12B product is that we've been involved in solar for the past 5 years. So we've already exited 200 million Rand solar portfolios on the same mechanism. And we actually exited them at around a 12% discount. So we believe 13.5% is conservative. And we've also run sensitivity analysis on that. And a 1% movement either way in that discount factor doesn't actually impact the returns in a significant way at all.
So just a question, Tivan, and was, how do our funds, so we saying that our projections are 18% and other funds are projecting 21%. How would you convince an investor to invest in your fund as opposed to another fund that proclaiming that they will return 21%. So what is your experience?
Yeah, Jeff, first, I think the proof is always in the pudding. But what's very important to note is that our investments or our funds to date have been 100% equity financed. So we have taken on retail investors' money and we have deployed 100% of that money into renewable energy generating projects. There are a number of other funds on the market which are incorporating gearing into these investments. And obviously, when you bring on gearing, you got to bolster the returns through that. So essentially, you can take on bank financing to bring an additional project into the portfolio. It's important to note it's in our investment mandate that we can gear the fund. But our focus now is deploying equity capital. We want to ensure, first and foremost, that our investors get their tax benefit. Once we have deployed all our investors' equity, and once we have a strong cash book, we can then go acquire financing at a good rate because we can show contractual cash flows and how the investments are yielding. And then we can bolster in an additional project into the portfolio. And then I don't doubt we'll see that bolster the return significantly across both funds.
So what I'm understanding is that the 18% is without gearing. If you did gear, and you don't necessarily have to gear in the current year, you can gear post Feb 25, because your investors would then still get an additional 12B, not a 12BA allowance, that would very much be enhance their 18% return.
100% correct.
Okay, good. So I think, and I think it's also, I think to the person attendee who asked that question, is our understanding is that the 12B fund is one of the only funds that we're aware of that deployed all their money into assets where you could get 125%, and a lot of the other funds in the market invested into used equipment, so where you only could get your 100%. So it's something, like I say, the proof of the pudding is in the eating. Right. So the question is, are the returns inflation linked in some way? Tivan, I'd like to ask that to you.
Yeah, it's also a great question. So and again, going back to the beauty of this product is that all the investments all the cash returns are contractually based. So we enter into these PPAs, and in the PPA, it will stipulate the variable tariff, a fixed tariff, the term, and we also build in a minimum offtake guarantee. So the offtake is guaranteed to utilize a certain percentage. But very importantly, we have an escalation built in year on year. So that variable and fixed tariff will escalate at a predetermined rate. How we've modeled it is we've modeled it at CPI plus 1.5. So it's also a real investment. We've got because it's pegged to CPI, you're essentially protecting your investment against inflation. And I think that's another beauty of this investment.
Okay, so let me ask you, so there was a question of how do you calculate the resale of the system, of the solar systems in year 10. I think you've addressed that. You sell the paper that for the balance of the 10 years, and you've got experience of doing that. And then I've got here is a question is, some of the projects have been running for almost 6 months now. How close are returns on these matching projections, and are the calculations accurate so far? I assume this would be in Fund 1.
Yeah, so the projects that have been in the money for a long period are tracking nicely. It's also important to remember the cycles of seasonality. In certain periods in winter, people will be consuming a lot more electricity, so we anticipate we'll see higher yields then, or higher returns, and we're tracking nicely to forecasted. A lot of our projects in Fund 1 did come online towards the latter part of the year and actually the start of this year. But once they've been, I assume midway through this year, probably June, July, we'll able to map quite nicely how the returns are doing. But I'm confident at the moment with how it's tracking. Okay,
just another one, and sorry, Tivan, this is a call-out. So a question about the semi-annual distributions. Can you tell us how they taxed in the hands of the investor? And is your 18% projected IRR net of tax or before tax? I think there's some confusion with that.
Yeah, sure. So firstly, it's important to understand the vehicle or the structure of the investment. So the investment is structured as an in-common partnership. And the reason we did this is so that we could get the flow-through principle, so that we could get the 12BA allowance to our limited partners or our investors. As such, the in-common partnership isn't a tax entity, so investors will be taxed in their individual capacity. So it's not like investing into a public unlisted where you'll get distributions and there will be or dividends, and there will be dividends withholdings tax. In the case of an in-common partnership, there will be distributions, and those distributions will be taxed at each individual investor's tax rate. And then on the return, or on the 18% IRR, that's after fees and taxes.
Okay, great.
If I could just add to that, sorry, Jeff, just to add a little point of clarity, which hopefully will address some of the other questions coming through, is if you strip out the tax effect, the projects are targeting a return of about 14–15%, roughly speaking. With the tax effect, both the tax deduction on the way in and the tax being paid on the way out, that IRR is enhanced to about an 18% annual return. So one of the questions was, what's the cutoff from an investor's tax perspective? And that is to say, if you are paying zero tax, you will probably get or the expected return, let me rather say, is about 14%. If you're in the top tax bracket, 45%, the expected return increases to 18%. And so everyone will exist, if the funds perform the way they're expected to, will exist within that spectrum. So the lower your tax bracket, the closer you are to about 14% return. The higher your tax bracket, the closer you would become to the 18% internal rate of return on an after-tax basis, both after tax on the way in and on the way out.
So, Victor, also so let's just say you've said previously this is a moderate risk type investment. If you invested into, let's say, fixed deposit, you would be getting probably around 8–8.5%, which you would be taxed at the 45% mark. So let's just say that you would be getting a 5% return, and here you would be getting an 18% return after taxes and fees.
Sure, yeah, with that 125%.
Yeah. I'm saying that's probably three times amount you would have if you had to put that into a fixed deposit or a bond.
Sure. If you bought a 10-year government bond, those numbers probably align. You'd be getting 10 or 11% from the government bond, but you got to pay the 45% tax on that. There's no tax benefit on the way in, so your IRR over the 10 years there would be closer to maybe 6%, let's say. And in this case, we're saying about 18%. Which is nice and attractive, and that's subject to the fact that if you're buying a 10-year government bond, at any point you can exit. With 12B, it's not as easy to pull out until the full 10-year period is up, and that's why it's an important thing to note. That's why we call it the illiquidity premium. Why investors can expect higher returns or demand higher returns, because they're not having access to their capital at any moment.
So just on that point, I mean, there is option subject to the fund's liquidity. As you know, that all the funds are invested after year one. So therefore, and you get your monthly contractual cash flows every single month. So there is options should an investor want to go out prior. So Tivan, question to you: if an investor, and there is one of the questions in the chat, is if an investor wanted to leave earlier, is there a penalty? What would that penalty be to address that early exit? Yeah,
so we do offer liquidity, obviously subject to the liquidity of the fund on hand. It is important to note that if you exit in the first 2 years, SARS will recoup you on the full 125%. So for the first 2 years, we don't advise exiting, and in fact, we do advise holding for the term of the investment. That's when it makes most sense. But if you do need a liquidity event, let's say at year 5, we do offer that we will buy back the LP's interest, and that will be at a haircut, which will be determined at that date given market conditions.
Okay, so then also listen, so lots of questions coming through, and Tim, this would come to you. Can a retail investor invest directly with you or need to go through an intermediary?
I'm sure Vic would like me to answer otherwise, but no, that we receive a lot of direct investors to Grovest or to the 12B Green Energy Fund. We have a great network of investors who have supported us through 12J and now into 12B. So you can directly invest into the product.
Okay. So there's a question here. Does the fund have a tax ruling from SARS confirming that the investors qualify for a 12BA deduction? Okay, can I take that one? So, Lewis, at the moment there are a number of tax rulings out for 12BA that says that the solar, the battery, the inverter, as well as the housings, the constructions, the cables, all that, the whole bang shoot qualifies for the 12BA allowance. Okay. People are asking, is this recording going to be available afterwards? Yes, it will be available afterwards. We have a Grovest channel or a 12BA YouTube channel where you would be able to get, to play back today's webinar. A question here, Vic, I don't know if you want to take this, or Tivan. What happens should an investor die during the lifetime of the investments? One, within 2 years, and then second, within the 10 years. And if you want to find a friend, I'm happy to take the question.
Yeah. My understanding is that it will form a part of that individual's estate, and the executor will have to decide how they want to deal with that. So if they want to hang on to it and continue with the distributions, pass it along to the beneficiaries of the estate, but it would effectively form an asset in that person's estate. Obviously, if it's a trust or company, those don't die, so there's no worries there. But for an individual, it'll form a part of their South African estate. Jeff, I'm not sure if you want to add.
If I can also just add, if a husband dies and he has a wife, he can bequeath it to the wife, and vice versa. If the wife invests, you can bequeath it to the husband, and there would be no estate duty.
Yeah.
If there is no wife, then and a husband dies and he bequeaths it to his children, then there would be estate duty.
Correct. So the normal section 4Q deduction, which is the spousal exemption of inheritance, that 4Q deduction would still apply. So spouses inheriting would be able to take over. The cash flows would start flowing to them, or all benefits and all proceeds. There'd be no CGT trigger at that point. There'd be no estate duty trigger at that point. The normal 4Q deduction would apply. If it's a non-spouse inheriting, there would be estate duty applicable, subject to the amount being above the 4A abatement, which is technical talk to just say it's normal assets.
Thank you, Vic. Tivan, there's a question here. Do we get your money back if not enough projects to invest in?
So luckily, Jeff, we haven't had to deal with that. And again, it goes back to, the emphasis we put on deployment. And again, that's why we've moved the peg forward and we're closing at 30th of June. So we have more than enough time to deploy the money before the 28th of Feb 2025.
So how does it work? I mean, on a first come, first serve basis. So as you receive money, you are deploying into projects. Those projects then become energy generating, and as a result will generate revenue. And then the investors who invested early then are entitled to that share of revenue. How do you allocate that revenue on a monthly basis?
Yeah, so what we've structured and how we've structured it is on monthly partnerships. And this is why we emphasize on a first come, first serve basis. And it's also important to note that we aren't raising the full amount and then only deploying it once the fund is closed. We're continuously raising and deploying. So Jeff, if you invested in January and Victor, you invested in December, Jeff, you wouldn't be prejudiced if we didn't deploy Victor's money, because it operates on a first come, first served basis, and we would have deployed the January partnership money in due course. So that's why we do advise investors getting in early.
Okay, great. And then also another to you, Tevin, the costs, the fees. What are the fees to an investor who invests in the fund?
Yeah, so we charge a 1% setup fee. This is for FICA and onboarding. We have a 2% management fee, so this is charged annually, and then a 20% performance fee. So it's a standard private equity fee structure. The 20% performance fee is only levied after returning 110% of the investor's risk capital. And why this is nice, and 100% transparency's sake, we take the majority of our fees in performance fees, and that means our values or our values are aligned to our investors. We have skin in the game. We really want this investment to do well, and that's why it is called a performance fee.
Okay, great. I hope that covers that. And and we're running out of time, so I'm going to run through these quickly. Is there a second-hand market to buy from someone who wants to sell, and does the buyer get the tax benefit? Tevin, to you.
Yeah, so you can sell your partnership interest voluntarily. The tax benefit will only be the 12B tax benefit. So 12BA will obviously be sunsetted, but 12B just has to be brought into use in the first time in the respective individual's trade, so they would be able to claim the 12B allowance.
Which is 100% of the value of the investment.
Correct.
Okay, question. I'm going to ask you, Vic, can monthly distributions be capitalized if not needed?
Typically, no. If an investment is made and then the fund closes, distributions are distributed, there's nothing to recapitalize in because the fund is closed and, pardon me, and the projects are now concluded. However, I have seen with some clients where they invested in Fund 1 and then a distribution was received while the window was still open for Fund 1, and that was allowed to be capitalized. But I think that would be again, on a first come, first served basis. They would treat their distributions as a new investment. And if the fund is already closed and deployed, then unfortunately, no, it cannot be capitalized, which is very common, by the way, for private investments, that once the fund is closed, distributions distribute out and they can't be redeployed into the fund.
But what you are saying, though, before the 30th June, if someone invested this month, 100,000, they could then, if they got distributions, or next month they wanted to put in another 50,000, they can put in, as long as the fund is open, which closes on the 30th of June, or the earlier of 100 million, they can continue, and there are distributions within that period. They can reinvest that distribution, or alternatively, they can put money in on a monthly basis, as long as the fund is not yet closed.
Correct, yes.
Okay, so what is the maximum liability to an investor if the fund goes insolvent?
I'm happy to field that one.
Yeah, go ahead.
So if everything went absolutely belly up, the maximum liability would be the amount invested minus the tax benefit. And that's one of the nice things is a portion of this return is certain, in the sense that it's a tax benefit from SARS. And with that certainty in place, investors can be reassured that that will be given to them. But even if the projects suffer for whatever reason, payment isn't received from off-takers or whatever it be, theoretically, that investment could go to nil, but the tax benefit would still be approved in that case. I don't know if you want to add more drama to that, but I think in the worst case scenario, it's really the investment amount minus the tax benefit that would be guaranteed to be received.
Okay, so I think what's important that the investors come in as a limited partner into the Commodore partnership, and they are limited to the maximum amount of the investment. There is the general partner, which is Grovest, and its partners would have unlimited liability, but the investor is limited to the maximum of his investment. No one can come and ask for more than what he invested. But I would like to believe that it's a very, very unlikely event. because there is a portfolio of assets over different geographies in different industries and across different solar projects. Now, I think a question here from Fikri, if you invest 100,000, do you get distributions of plus minus 14% on the full 100,000, Tivan?
Yeah, that's correct. So it's an average of, I believe it's 14.2% average annual yield on your gross investment. And that's interesting. And we exclude your year 10 exit in that because it would skew it drastically, because in year 10 you're getting your capital back plus some.
Okay, just last question because I'm conscious of time. Does the investor get a tax certificate and a pack from the fund, Steven?
Yeah, so we issue quarterly reports firstly, which will track the progress of the fund. We'll give project updates, but then importantly, we also issue our investors with a tax certificate, which will then stipulate that they've invested in the 12B fund. It will split the distributions and interest as well, and we actually directly allocate an asset just for tracking purposes.
Okay, great, guys. So that it brings us close to the end of our webinar. We've got 2 more polls for you. Can we have poll number 3, please? Okay, do you have a dedicated financial advisor, wealth manager, or are you responsible for your own investments? I think Vic is very, very interested in this. And also that I'm sure if you wanted to, Vic, to contact you or you to be in touch, Vic, how could anyone on this webinar be in touch with you?
If they do want to contact me, they could either email our financial planning division. The email address is finplan, FINPLAN @ Golf India Bravo.co.za, or you can email me directly, victor@gib.co.za, and I can pass you along to a team member that can assist.
And obviously, if anyone wanted to get hold of Vic, they also can just contact us directly at Grovest or the Green Energy Fund, and we will then pass on that information to Vic. Right, the last poll. Can we have the last poll? So the last poll, number 4. And this is, would anyone like to schedule a meeting with Tivan to discuss the product in more depth? Yes or no? If you wanted him to, by clicking the yes button, there will be a report and he will be in contact with you. Alternatively, Tivan, how does anyone on this webinar who wants to get in touch with you contact you?
Yeah, they can email me. So it's Tivon, TIVON @12B. So the number spelled out, TWELVEB.co.za. And happy to set up a meeting or even meet for a coffee, all on Jeff's account, of course.
Of course. First class.
Jeff,
and then obviously, just for those who want their CPD certificate, please, how does one get their CPD certificate? Can we please put that on the screen so any participant who can get their CPD points? Okay, so to claim your CPD points, you need to please get in touch with Tumeleng at Grovest. So it's ITUMELENG at grovest.co.za. And she will obviously verify that you were on the webinar, and she will get a certificate to you within the next week or so. Guys, very quickly, closing remarks. Let's start with you, Vic.
Sure. Thank you so much for the time, everyone, today. I think the big takeaways for me are this is a potentially attractive investment, not necessarily suited to absolutely everyone, but it is suited to a lot of investors. One of the big things that we didn't get a lot of time on today that I think is really worth noting is the impact element of this investment. And by that, I mean, this is a primary investment into the positive progression of our nation in the renewable energy space. It's got a positive ESG flavor, environmental, social, and governance flavor to it. And it's a great space to be in, subject to one or two caveats, which I hope have done a good job in giving a balanced approach in today's webinar, that there are some things investors should be aware of. But if they're comfortable taking on that illiquidity, that long time frame, and understanding this is a private investment, we think it's one that is quite attractive.
Kevin, your closing comments?
Yeah, I think I mirror Vic's sentiments 100%. I touched on why I'm so passionate about this product earlier. It really is an investment which, you know, has so many facets to it. The impact investing side, the tax benefits, and the high returns. So I really, from a personal point of view, am passionate about it. And yeah, just thank you so much for joining us.
Well, thank you, guys. Thank you, Vic. Thank you, Kevin, for your input. It's been a really informative session. I think it's been very interactive. We've had lots of very, very good questions from the viewers, and hopefully we dealt with them to their satisfaction. But anybody who still wishes to get more information, please, you can either get hold of Kevin or Vic, and they would obviously be able to assist you. There is marketing collateral, there is a website, and obviously we're here to assist you and to guide you through any questions you may have. So thank you, everybody. Thank you to the Grovest team for putting this together, to Jenna, Terry, and the rest of the team. Much appreciated. And we look forward to meeting you soon in person, and to further and more webinars in the future.
Thank you.
Thank you.
Thanks. Ciao, ciao.